we recommend that the incentive compensation of senior bank managers and the board members of these banks be restricted to restricted stock and restricted stock options. Restricted in the sense that the shares cannot be sold or the options exercised for at least 1 to 3 years after their last day in office or after their last board meeting. This incentive compensation program will focus the attention of the senior bank managers and the directors that serve on their board on creating and sustaining long-term shareholder value and discouraging investments in projects and trading strategies that are high risk but ultimately value destroying. We would have to unpack this question a bit. The cause of the last crisis was the Community Reinvestment Act that was passed by the US Congress in the late 70s. The motivation behind this act was initially honourable, as they all tend to be when the laws are first passed, to allow individuals to buy homes and afford mortgages that otherwise they would not be able to afford. Over time, this led to mortgages being issued to individuals that had no credit and no income. Clearly, this is not a sustainable economic system, and something had to break, and that's what we saw in 2008. So what I want to make sure is that while a focus of the book is on the incentive compensation of the big banks, and also, as I might add, for the non-financial industry, the cause of the crisis was this Community Reinvestment Act and two government agencies, Fannie Mae and Freddie Mac, were very active aiders and abettors in this process. In that vein, I might also add that the big banks, while they did not cause this crisis, they were active aiders and abettors in what happened subsequent. They originated and distributed many of these subprime mortgages. If they had not actively engaged in doing so, the crisis may have been of a lot smaller proportion than what it was. There have been two major thrusts as to how to address the crisis that we saw in 2008. US Congress has passed the Dodd-Frank Act, and a lot of it is geared towards ensuring that the too big to fail banks is a thing of the past. However, most investors and senior policymakers do not think that the big banks are a thing of the past. Indeed, as we have seen very recently in the ongoing Republican and Democratic presidential debates, there is continuing concern that the big banks are still too big to fail. Some have recommended that by imposing an explicit or implicit cost or a tax on the banks to keep their size smaller than what they would be otherwise. We do not walk down that path. The other set of recommendations that have been made have had to do with looking at the incentive compensation structure of the big bank managers. Our proposal falls broadly under this umbrella. Now, there are three general types of proposals that have been made with regard to incentive compensation of the big bank managers. The first one that we ascribe to looks at the incentive of the long-term stock and stock option programs. The second one type looks at this clawback feature that some compensation contracts have, This clawback feature essentially claws back any bonus that may have been paid to the manager if the company's earnings or other financial statements have to be restated. We think this clawback feature is, we think it is toothless, to use the same analogy. And the reason why we think this is not effective is, one, if we go back and look at the big banks in 2008, none of them had to restate their earnings or any financial statements, yet we had this big crisis. The other reason is that the clawback only relates to their bonus that they're paid. What our research shows that bonus and salary, while it looks significant, is only a small part of the overall management compensation. The largest part of the compensation consists of the stock and the stock options, and that's what we focus our attention on. A third incentive compensation plan that has been proposed includes some semblance of incentive equity contracts and incentive debt contracts. Now, if you include incentive debt contracts, i.e. trying to enhance or maximize the value of the bank's debt, it's like trying to serve two masters. And even the good books say that it's very difficult to serve two masters. If you ask managers to maximize the share price and then also tell them maximize the bank's debt value, that leads to conflicting set of rules with regard to the bank's investment policy, trading strategies, dividend policy, and that is simply not something that makes a lot of economic sense. We think corporate directors of these banks are likely to be more supportive, and even some managers, at least publicly, would be supportive of our proposal. And the simple reason is, if you were to ask these directors or any senior bank manager as to what exact objective do they have with regard to their jobs, and is that objective not to maximize long-term shareholder value, very few of them would want to disagree with that proposition. They might add a few other things, and that's fine, but this has to be a central part of their job objective, if you will. That being the case, what better way to align their incentive to maximize and sustain long-term shareholder value than to have an incentive compensation program like the one we outlined, where their incentive compensation consists of restricted stock and restricted stock options, such that they cannot sell their shares or exercise the options for 1 to 3 years after their last day in office. That being said, to be fair to the managers and the board members, incidentally, while there has been a lot of talk about the executive compensation of managers, there's almost no talk in the media or in the literature about compensation of directors, which we think is at least as important. To be fair to these managers and directors, our compensation program will lead to under-diversification and lack of liquidity on the parts of these managers and directors, and that's a legitimate concern. We have tried to address these legitimate concerns in our proposal by allowing these managers to sell some of their shares, and the directors also to sell some of the shares and exercise the option on an annual basis. How much they sell is a decision that we have left to the corporate board, more specifically their compensation committees, to decide. It is not our intention to micromanage this compensation proposal. We have given the broad outlines, and we have given suggestions as to where there needs to be some deviation. For the same bank, they may have either once, even for the same bank, we are not saying one size would fit all. The board may decide that for different managers, they may allow differential amounts to be sold every year. Let the board make those decisions. We've given some guidelines as to the maximum percentage of shares that they may be allowed to sell. However, our intention is not to add on one additional regulation, but let the board make these decisions. The financial crisis that started in 2008, that is still with us in some ways today, that was not caused by the big banks. To be fair, this crisis was caused by the Community Reinvestment Act that was passed by the US Congress in the late 70s. Essentially, it encourages and allows individuals to buy homes that otherwise they would not have the income or the credit to afford those home mortgages. We have had two government agencies, Fannie Mae and Freddie Mac, actively promote these policies with their investment and trading strategies. These big banks have been active aiders and abettors of the policy to allow individuals to buy homes that otherwise they could not afford. So by adopting our compensation policy for the bank managers and directors, we will get the banks to do the right thing, i.e. not engage or not enable and abet what the policymakers have done in terms of trying to allow individuals to buy homes that otherwise they could not afford. So that would mitigate the size of the financial crisis. Additionally, if the big banks were not in a financial crisis themselves, then the larger non-financial sector also would not be impacted. However, to be fair, the basic cause of this crisis, if Congress does not reform, privatize Fannie Mae, Freddie Mac, does not make some changes to this Community Reinvestment Act and have some guidelines that people, when they wish to buy a mortgage or wish to buy a house, they need to show some income, there needs to be some verification of credit. If we don't go down what a sensible economic path may look like, then this crisis is going to come back. There is a larger policy issue that the Community Reinvestment Act was trying to address, that that home ownership is a good idea. Well, we may or may not agree with it, but let's say that home ownership is a good idea. Fine. Even if home ownership is a good idea, if people are buying homes and putting 0% down, where is the ownership? I have another question, I have another comment on this, which is, even if we assume that home ownership is a good idea, and as a society we need to allow some individuals to own homes who do not have the income or the credit to own homes, a lot better way to accomplish that is for the US Treasury to directly write subsidy checks to these individuals such that they can buy and own those homes, rather than go through this mechanism of using Fannie Mae, Freddie Mac, the large banks. This just leads to the brittleness and the crisis nature of the entire financial industry that then spills over in a very negative way to the rest of the economy. There is no need to provide these subsidies through a very elaborate channel, and there's a lot of loss of taxpayer dollars at each stage. If we as a society decide that some people who can't afford homes should be able to buy homes, that's a policy decision that I'm willing to live with. But a lot simpler way to do that is simply to get the US Treasury to write the checks. It's a lot more transparent as to what we're doing. There is no sort of negative externality, if you will, of bad outcomes spilling over to the rest of the economy.